Hi friends, today I'm going to talk about peculiarities of equity instrument. I won't bore you with the theory topic, but trust me, it will give you a new outlook. Just as a backdrop, generally, whenever people try to understand equity instrument, it is all about features of equity instrument. But it is the same for every form of company, like private company or public company. But don't you think equity instrument adds even more colors to itself when it starts to trade in stock market? So today I'm going to share few of them that caught my attention while tracking stock market. Again, a word of caution, these phrases are neither features of equity instrument in stock market nor any stock market quotations. Invest very less money and make a quick money. With active markets, you can invest less money as low as price of a single share and make quick money if prediction turns your favor. With transferability and active trading in exchanges comes added advantage. These may not be possible with a private company or an unlisted public company. Two companies with different share price may post same profit. Even though two companies start posting same profit from initial public offering times, the share price can be different. These can be because of various corporate announcements like splits, bonus, rights issue, etc. As more shares are pumped into the market, the share price reduces proportionately. So, it is always better to compare two companies in terms of market capitalization rather than share price. Here is an example where two companies have same profit but a different share price. Lower share price and undervalued are different. As previously mentioned, lower share price is an outcome of corporate announcements like splits, bonus, rights issue, etc. Whereas undervalued can be an effect of various reasons, like if a company PE is below industry PE, or price is below book value, or company is available at attractive dividend yield. So, lower share price do not mean a share price is undervalued. They can be different altogether. Price corrects so much that people think there is value. 100 to 1 rupee fall means a 90% fall after a 90% fall. Market is a discounting machine. Whenever there is an uncertainty about future earnings, market immediately shows the impact on share price. As long as uncertainty bothers market, so long will share price take a beating. Do not buy anything with just a hope of price recovery. An anticipation of reversal shall be out of reasonable estimates. Time questions conviction. Buying equity means buying future, and an important element is to buy with conviction. So as time passes, it tests patience level when share price do not move the expected direction. So in this situation, he can either buy more or sell his holdings. Investors invest only when there is certainty about future earnings. So every dip is a buying opportunity. If you are so convinced with the potential of a company, you will not sell. So, if you are selling, you are questioning your previous conviction. So, one goes to extreme opposite directions. One cannot take both the alternatives. So, time surely questions conviction levels. Gain is actual when you sell. Share price may move up, showing profits on screen. That doesn't mean there is income in your pocket. If share price reverses, then you're back to zero. So don't celebrate with a notional gain. The gain is actual when you sell. stock market mantra: to prove a point with money, and to prove a point may not be with money entirely. Stock market is not for psychological satisfaction. There is no point of identifying a potential stock and just watching that company grow without investing. Stock market is to make money and not to prove a point that I know a particular stock. So it is about investing in that particular stock. So it is all about money. Now another side of coin. Well, it may not be about money entirely. If one has high level of conviction, then the portfolio will comprise of only one stock. But everyone goes through portfolio building to reduce risk and arrange returns. So, share price gain may not be complete gain in portfolio. When it comes to portfolio, it is a partial gain. In this way, stock market is to prove a point with money, and to prove a point may not be with money entirely. Incidence and impact. The more a company is exposed to an incident, the more impact it is going to see, either positively or negatively. For example, let's say if government comes up with strict rules towards water treatment for chemical industry, then all companies in that industry has to make arrangements to follow with government policy. Now, a company that is proactive and has already made arrangements with stringent quality policies, then this sudden incidence has a lesser impact. On the other hand, a company that never bothered with these regulations will see this all by surprise, and company may have to divert a large cash reserves towards government regulations immediately. So this incidence has a bigger impact. So share prices among industry may react accordingly, and movement of share price is regarding particular incidents and impact. So the more a company is exposed to an incidence, the more impact it is going to see, either positively or negatively. Nothing happens without a base. Share price movement is a consequence of previous action. So, cause and effect principles very much apply here. You may find a share price attractive at current valuation, and any further fall can increase buying instincts. But a fall definitely has a negative emotion attached. Otherwise, why will a share price see a sudden free fall? If a price is falling and investor has opposite emotions, it is better to find out the primary cause for such sudden fall and any possible future outcomes that can have an impact rather than aggressive buying. So better to have wait and watch approach than falling prey to buying instincts. More money is lost in a waiting for correction rather than correction itself. The word of caution today is do not be cautious. If you are not invested in stock market or not stayed invested, you have already missed 80% of appreciation, which even from equity stand is a 4 to 5 year gain. So, in my opinion, more money is lost in a waiting for a correction rather than the correction itself. Industry may not see symmetric gains. Even if industry is in advantageous position, still all companies may not post similar profits or see similar increase in share price. It all depends on individual capabilities and possibilities. A company, considering its business model within governing laws and regulations and available resources, derives its net profit, and market rewards share price accordingly. So, industry may not see symmetric gains. Hope you like this video. Subscribe to Share Subu and click the bell icon so that you will never miss an update.